Hello and welcome to the Harwood Report for May 21st, 2018. I'm Keith Harwood, the host of the Harwood Report and the founder of Trade Academy. As always, all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. So this week I'm going to go through the stuff I normally go through: equities, bonds, VIX, gold, oil. What's the technical picture going on here? What seems to be going on fundamentally? And how can I execute my view using options, which has been my expertise. So let's get right into it here. The first thing I like looking at is fear and greed as an indicator of what's going on in various products. So we see that bonds, options, and some of the individual equities are showing some greed and neutrality, or at least neutrality, and yet the index is showing an extreme fear, quote unquote, rating. That tells me that the market has a little bit of catch up to do, or some of these other indicators are all mispriced. Most likely to me, that means the equities are going to try to catch up. So let's play through the charts a little bit here. SPY sitting at 273.05 and pressing towards the May 14th high at 274.08. Gets through there, we're looking at 277.5 and probably closer to 280 in relatively quick order. We've got the end of month coming up. We've put China trade issues kind of behind us now. So what's the drag on the market right now? Maybe it's a little bit of money flow. End of the month window dressing, that should bring the money flow back. So that's what I'm looking to play for. And the way I'm looking to do it is with the options. So I look at the term structure here, and I don't really want to play in the next week's options. Even though they look a little bit cheap, they are not necessarily cheap because there's a long weekend. So how do I play this? I go out to the following week. I go to June 4th, 9% cheap, and I look at the 275 calls here for 116. Okay, that gives me a really good run for 277.5, a great R&R if we get to 280, and I just manage that position if we pull back below the 100-day moving average, which we're about $1 above. Sorry, $3 above. If we get below the 100-day moving average, I'm starting to look again at a press towards the 200-day moving average and maybe further. So I'm a little nervous if that doesn't hold. That said, when I look at IWM, we are running away from those moving averages. 10-day moving averages above the 20-day moving averages, above the 50-day moving averages, above the 100-day moving averages, above the 200-day moving average, and all-time highs every day. So small caps are giving us bullish indicators. On top of that, I look at the Qs. And that is much further away from the 100-day moving average as well. So I've got a lot of sector strength, particularly in momentum style stuff. Yes, the Qs have underperformed IWM, but with China trade talk off the table, this should get more money flow. Patent law gets discussed more. Tech companies become a better bullish play. IWM was initially one of the plays because it was more of a domestic play with China trade concerns. Well, if those are behind us, I like to think that people are going to put some more money back into tech, okay? And semiconductors are a big part of that. Let me get over to TLT. TLT is bouncing a little bit of a dead cat bounce. What I'm looking for here is, frankly, just to move back to 119. If we take out the previous low, who knows how low we go, but 119 is a reasonable way to play this in a relatively choppy market. When we get to these lows, we tend to kind of bounce back a little bit before the next leg lower. It's easy to play something like that with the options when vol is as cheap as it is in TLT. Vol rarely gets below 9%. The front of the curve is a little bit bid, May 25th and June 1st. So simply put, I can go to June 22nd and get long some 119s. And against it, I can sell a June 1st 119. So you can see that that's a flat vol curve. This should be at a relative discount, in my view, because of the long weekend. And so if I put on that spread for 45 cents, I've got a pretty good R&R. Okay? So that's how I play a calendar in this. It's got a long delta into a rally. That should help if the vol does come off about 0.5%. Next week's vol is basically too high, or the following 2 weeks later vol, or 3 weeks later vol is too low. One of the two, in my view. Okay? Let's keep walking through this because the exciting stuff is honestly coming. Dollar yen just continues to drift higher. Dollar's firm. Everything seems to be looking good here for the dollar, which is not good for gold. But how much lower is gold going to go right now when we've got this big consolidation area here around 121? Frankly, I think that that's going to create a good amount of buying. I think that the play here is a grind lower. I'll talk about how to do that type of trade in the newsletter. How I can play a grind lower in gold down about $1 over the next couple weeks. Similar ideas. If I go over to the minors, I'll just look at the juniors here. I think the move is down towards 31.5-ish, that consolidation area. And again, we're looking at how do I play a grind. And in the junior gold miners, vol is very cheap. There's some ways to play it that are kind of fun. And finally, silver, it's just a chopping trade between 15.25 and 15.80. And so if gold does fall out of bed and gets down towards like 119 or 118 in GLD, then maybe finally silver can get hit. But until then, I look for a play on a consolidation trade. And again, I'll talk through how to do that in the newsletter. I want to get us over to oil. So when I look at oil, new highs. Brent oil is a big one to look at here because those futures are pressing $80. So we can see why there's a general bullish tone around the oil names. So when I look at XLE, which is above the January highs and well above last year's highs, keep that in mind. Remember this, that was 70.5. We're over 10% higher than that. Okay, and it's breaking out again today. But maybe even more important would be OIH. As long as USO stays firm, I want to be in OIH, not XLE, because this breakout's just getting started. We're depressing those January highs. And notice that last year, this time, it's trading 31. Okay, so if that was trading 31 a year ago, when XLE was trading 70, I get it. They may have lost some money when oil was cheaper, but right now they should be, these oil services companies should be starting to really pick up some money. Okay, and if they're making a lot of money, that's going to push us higher than this 31 kind of level. If we go 10% over, we're at 34. OIH is a more volatile ETF traditionally than XLE. And when I look at the term structure here, I see some really good options in just going to June 15th and buying some 30.5 calls for 39 cents. Gives me a lot of leverage for a breakout. If it keeps going, I can roll, I can manage this position. I've got a lot of ways to play around with it. There's a lot of leverage in 30.5s if this stock goes to 34. Yes, the 32s would make a lot of money on a move to 34 as well, and they seem cheap. But if the move stops around 31, 31.5, I still make money on the 0.5s. It's just a matter of how much money I'm going to make if the move is smaller than that outsized play. So that's my final trade for the free stuff today, is buying these June 15th 0.5 calls for 39 cents. I discussed a little bit the Harwood Report. Sign up now and you get the first 2 weeks for free. After that, it's 49 bucks a month. It's a pretty good deal given that I'm doing the newsletter, which talks through ideas in each of the ETFs I discussed today. I also do an updated video on Wednesday. I talk a bit about how I would look to how I will be expecting to manage positions if I put them on, levels that I'm watching in terms of technicals as well as in volatility. Give a lot more information for that. Go to tradeacademy.co/Harwood Report if you're interested in signing up. And finally, if you need to contact me, feel free, Keith@tradeacademy.co or 312-600-8004. Thanks again, folks, and have a wonderful afternoon.